From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, June 24th, and you're listening to the Macrocast, brought to you by Hamilton Place Strategies and Market Policy Partners. I'm Bryan DeAngelis, a partner here at HPS. I'm filling in for Tony Fratto, who's taking a much-deserved vacation over in Europe. And as always, joined by our good friends, John Fagan and Brendan Walsh from Market Policy Partners. Guys, in a weird way, I think I'm filling in a little bit too for John Dick of Civic Science, who's normally our guest around this time every month as we release our latest economic sentiment index. I wanted to start there and get your reactions on that. Because at least to me, something interesting happened with our ESI this week, which is we saw a big plummet in confidence around personal finances. And this has been the one factor that's been kind of staying pretty high and pretty afloat post-COVID with, just we've talked about this many times before. I know John has raised this many times before, but folks have just felt really good about the money in their bank, the money in their pocket after the relief and other efforts that came during the COVID pandemic. It was sort of the one thing keeping things going in a stream of bad news on the economy side, but it just tanked this week. It fell, I want to say, a good 8 points. This is, I think really a reflection of like inflation's finally hitting people's pocketbooks and probably has been for a few months. And we've been surveying this for a while, but all of the talk we've seen in the economy and others, now folks are starting to feel it too on their own personal side of things. So wanted to sort of start there, get your reaction to that. We'll jump into Powell's testimony up on the Hill this week as well and some other issues. But how does that sort of align with what you guys are seeing out there in the markets?
Yeah, certainly. Thanks, Bryan. And it's always great to have you fill in. We're, we've been looking for, we haven't been alone in looking for softening in U.S. economic data to follow the deterioration in the sentiment indicators. We've just seen this divergence for months now of sentiment indicators really plumbing some pretty grim depths. But the actual figures themselves, whether you're talking about non-farm payrolls, whether you're talking about purchasing managers indexes, PMIs, and so forth, and even retail sales. There have been signs of weakness, but economic data has been something like a Rorschach test, right? If you're looking for weakness, you can find it, right? And if you're looking for resilience and strength, you've got plenty of evidence for that too. The most likely explanation for the divergence, of course, is that economic data is backward looking. The surveys are a little more forward looking, and ultimately you will see the persistent headwinds of high gasoline prices, high food prices, and generalized inflation sapping consumer vitality and creating just what you described in the gauge. Households beginning to feel worse and worse, incrementally worse about their economic and financial situation, and then having the actual data come in line with that deterioration over the coming months.
Yeah, and I should note the way we craft these surveys with Civic Science, it is that kind of forward look. So how do you feel about your personal finances over the next, I believe the question is worded over the next 6 months. How do you feel about purchase of a new home? How do you feel about the U.S. economy? And as I said, I mean, this is our lowest rating of the year generally, but we've seen a lot of this dovetailing with the economic data that's out there as well. And this personal finance one finally took the hit. And, guys, I do want to ask, part of this is obviously, people seeing a lot of action on the federal government side. Powell and the Fed raising rates, Biden talking about gas tax and other issues, which we'll discuss. I just did the annual family road trip over Father's Day and got killed on gasoline prices. It's certainly big issues and causing a lot of fears of recession. There's more kind of talk of that being baked in. How are markets kind of looking at, and this will probably get us into some of the Powell conversation, but are we still looking for that soft landing? Are we heading towards a recession? What are you guys thinking, and what are markets telling you?
Well, the market's the classic recession indicator of the Treasury yield curve, and that's the spread essentially between longer dated and shorter dated Treasury yields. The classic portion of the curve is the 2-10 spread, and that so-called yield curve inversion, when the 10-year yield goes below the 2-year, that's your rock solid and very well proven recession indicator. It went negative very briefly in April. It's flirting with inversion. We're seeing volatility in equities, obviously, around this kind of stagflationary concern. Essentially, there's competing. It seems like every other week, are markets worried about growth? Are they worried about inflation? The reality is they're worried about the confluence of the two. That the Fed reacts to high inflation with aggressive rate hikes and induces a recession, a hard landing, and that really is, manifest in the steep equity declines that we saw over the last couple of weeks that followed that hotter than expected CPI number. And now the Fed has told us, they're going to be responding to a whole panoply of inflation data. But next week, we've got their most preferred inflation metric, the core PCE prices index. And so every data point that comes out now has, the potential to induce a huge overreaction in financial markets, whether it's an upside surprise or a downside surprise. So it's a very tough macro environment for investors to begin to build up long positions, get back into stocks here, because you've just got such headline risk around these individual, data points, which can be on any given month quite noisy.
Yeah.
We may well look back at the CPI for May and say that was an outlier in a slowing trend. But the market isn't going to wait around, doesn't have the luxury to wait around to see it, given the way that the Fed is pretty jumpy and quick on the trigger here.
Yeah. Brendan and I were talking before the show, the word of the week seems to be unconditional with Powell's testimony, talking about his focus on inflation, their commitment to continue fighting inflation, even as some Democratic senators raise questions of a recession. Some Republicans continue to push them to fight inflation. How are markets taking, his commitment to unconditional? And I don't mean to jam you guys with two questions at once, but saw, I think it was Bowman, talking about another 0.75 that seems to now be baked in for July. I wonder if you guys share that view as well.
Yeah, you have to take a couple steps of the way the market's thinking of it. I think after the CPI and now, with the last two times Powell has spoken to us, he said, we're gonna tighten, and 75 is baked in. The market is definitely reflecting that. A measurement of what the market thinks inflation is going to be 5 years from now. It's called five-year break evens.
Yeah, those
are back. At 2.6%, where we were, in January before all this stuff happened. So the very forward-looking part of our market, and one of the more efficient measurements we have. It's not a measurement. I mean, it's a trading mechanism. So people are making bets that this is happening. It is assuming that inflation is going to kind of go back to where it was in 3 to 5 years' time. But we've also seen industrial metals come off very hard. But that started a few months ago. This is also following through to some agricultural products, and even oil prices are down. So WTI was $120 last week, and now it's down to $106, we had similar, declines in the Brent crude, which is the more international measurement. So the market is starting to price in. The market's basically believing that the Fed is going to tighten because they're doing it.
They're doing it. Yep.
But we've also seen the equity market, which is the more kind of speculative part of the market, rally this week. So I think we're also getting to that point where the market now is saying, I believe you, Fred, that you're going to hike 75, here in July. And maybe you'll even do, 25, 50 in September. But we also think that you're slowing the economy down enough that you're going to get spooked in a couple months and back off from this harsh talk. So I think we're at the point of second level or second derivative thinking on the Fed.
Yeah.
Yeah. Bad and soft.
Yeah. We don't want bad. Yeah.
Yeah. So basically, the new Goldilocks, in the old formulation, it was Goldilocks, which is inflation's hot but not too hot, and this the economy's hot but not too hot. This is kind of inverted, which is the economy is slowing but not too abruptly, right. And so this week's purchasing managers index is coming in below in a downtrend, below expectations in some cases, increasing.
Getting closer to that. 50 is a break even. Above is growth, below is contraction. And basically all the global ones are now spitting around 51, 52. So we're getting close to contractionary, but not quite there yet.
Yeah. There seems to be more and more, I don't know, tell me if I'm wrong, but a little more confidence that it could be a soft landing rather than a pretty hard landing, to use the Fed's terms. And I believe I read earlier today that, we're now looking at, I think, the second half of 23, where we'll start to see rate cuts as things sort of smooth out and we get back there. I saw our old Macrocast live friend, Nathan Sheets, is predicting a recession at around 50%, but that seems to be the highest number I've seen. Most people are still under 50% chance that this is a recession and we can do it in a slowdown. I don't know. You guys agree? Yeah.
There's a lot of commentary that's on the more negative side, like former New York Fed President Dudley coming out and saying basically a hard landing is a fait accompli at this point. The Fed cannot achieve their inflation goals without a hard landing. We've heard very similar stuff from like Larry Summers, similar things from Mohamed El-Erian and others when you start talking about which hedge fund and leading financial market individuals, they're always talking their book.
Yeah, right. Exactly.
They're wish casting in a lot of cases and with their commentary. But a lot of prominent economists are pretty negative on the outlook. You can see why we've had this. I think that the CPI number that came out in May was very dispiriting, and that's. And the Fed is essentially just have the blinders on, right? What the Fed is not really discussing, not just Jay Powell, but across the spectrum of Fed governors and so forth. They're just not talking about the balanced risk between growth and inflation in the way that the markets think they probably will need to. By later summer and into the fall, where the slowdown is manifest. And the Fed is beginning to say inflation is on a narrower and narrower kind of categories, specifically food and energy. And obviously those have spillovers, but those are supply shock stories rather than, monetary, overdone money printing.
Yeah. Can I can't help myself, but put my political and congressional cap on sometimes. And I'd love to ask you guys this. We obviously haven't seen this level of inflation and this response from the Fed since, I was a young kid, 80s. How much is the Fed either paying attention to or afraid of what I imagine will just be an onslaught of inflation-focused political advertising, political commentary all through the summer and the fall leading up to the midterms? I mean, this is going to be issue number one, and I imagine some pretty scary, commentary around it in a political sense for voters, consumers on our airwaves every day. How much does that factor into how they're considering the economy's, mindset and how they respond to it?
Yeah, it really is a challenging dynamic, and the Fed is in the hot seat. The Biden administration has tried to put the spotlight on the Fed. It's the Fed's responsibility, but at the same time they know the political realities. They have to do something, and that's there's not that much they can do. We'll talk a little bit more about this gas tax proposal, but. Short and obviously, the energy industry and the sort of pro-energy crowd are just heaping abuse on the Biden administration for what they call, misguided energy policies, and the hypocrisy, the inherent in their pivot to try to gin up supply and reach out to Venezuela, and obviously most prominently the upcoming trip to Saudi Arabia.
Great. Well, let's why don't we pause there for a minute? We can take a quick break, and when we come back, let's jump into some of the global stuff and Saudi Arabia and some of those other issues. You're listening to the Macrocast. We'll be right back.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through hamiltonplacestrategies.com.
And we're back with the Macrocast. Bryan DeAngelis here, subbing in for Tony Fratto, and as always with John and Brendan from Market Policy Partners. Guys, just shifting gears and looking outside of the U.S. a little bit, although obviously a big factor. Brendan, I know we had some numbers this week, and things are looking like they're slowing down globally. Tell us more about what you guys are looking at.
Yeah, so this week it was actually a very important week for global data. There's a group, Market does global PMIs, so both manufacturing and services. It's kind of helpful because they have the same methodology, so you can kind of compare them across the major economies. And really, everybody saw a significant slowdown, both compared to the previous month and also to the expectations of what economists were expecting. Everything is still in expansionary territory, so that it's above 50, but we're getting closer and closer to that 50 number. Below means that the sector would be in contraction. So that's probably the most important recent data point we've had. But kind of going back also to, there are some, commodities that have been slowing down. Industrial metals, copper is kind of a very good example, because it's used in building products, right. and that's come off a lot. We're also seeing global shipping rates come down a lot. Lumber's come off a lot. And that's not as shocking either. The 30-year mortgage is now close to 6%, where it used to be at 2.25% a year ago. So the Fed's tightening, and not just the Fed. Global central banks across the board are tightening. So
yeah, how much of that is? I'm just curious. How much of that is also supply chain? I mean, I was on this show probably a year ago talking about just the back, maybe 2 years ago, actually, but lumber jumped out at me. We had a conversation about how they just all shut down. And so the supply was way behind. Obviously, housing's going to slow down with interest rates. I think we're pushing 6% on the 30-year mortgage, but maybe it's a dumb question, but it seems a little bit of both, right?
Well, the spike in prices, years ago, especially in lumber, was definitely because of supply issues. We still do have some supply issues, a little less domestically in the labor market. I mean, the lumber market. Now it's much more of a China issue because of their zero COVID strategy. So, on the semiconductor side and chips, we're still seeing a lot of slowdowns. Elon Musk said that his factories in Texas and Germany are burning billions of dollars every month because they can't get the parts quick enough. So that is, but the supply issues would be inflationary, not deflationary. The deflationary aspect is very much because of global central bank tightening. The RBA, the Australian Central Bank Governor Lowe, gave a speech a couple of days ago, which was very enlightening. And they had been hiking. They hiked 75 basis points the last meeting, and the market had been expecting another 75. And and the speech said, no, it's going to be either 25 or 50. That's the only things we're discussing, because the coordination of global central banks has really very much slowed down the global economy. And Australia, being a heavy export commodity economy, it would see that first, front and foremost. So they're one of the first central banks that had been hawkishly tightening to do a somewhat dovish pivot, not to take off hikes, but to slow the pace. And that's kind of what John and I think we're going to see come late summertime with the U.S. That the July 75 basis point is fully priced in. There's no necessarily huge reason to take that off the table unless something.
And that's not even hawkish at this point, right? That's
right. But what is priced in the rest of the year, especially that September meeting, I think the Fed is going to find that the economy has been slowing, and maybe the inflationary pressures within some of the components of the CPI and PCE, especially the car prices and even possibly some of the housing market, is going to be slowing enough that it doesn't justify cutting rates. It doesn't justify stopping rates, but it can justify slowing the pace that the market is currently expecting.
Yeah. And just for our listeners, I want to flag a point you made. I mean, people have been pretty aggressive and pretty coordinated. I think it's something like, I probably got this from you guys, but I think 40 central banks have already raised by 75 basis points this year. I mean, people have been pretty aggressive, and I think that's important for folks to know. This isn't just the US.
But it's also instructive to look at the outlier, Japan. And we talked a bit about Japan in the past weeks, and how the Bank of Japan is totally diverged from global central banks tightening. They had their meeting last Friday. They held on, doggedly to the dovish, ultra accommodative settings, the yield curve control, and everything, despite the yen kind of taking a bath here and languishing at a 24-year low against the dollar. The central bank held the line, and they've got a leg to stand on. Their CPI data came out overnight, and ex food and energy prices, it's 0.8%. And this is, when you say, this is a gigantic monetary phenomenon, it's because the money printing is going crazy. Japan's been printing money and never stopped. And, they're inflated. Their headline inflation is 2.5%. Their core is 2.1%. It's all energy and food. And Governor Kuroda, in his last year of his in his decade-long tenure of campaign to try to defeat deflation and disinflation in Japan, is saying, hey, look, when we look at this, it is very narrow, and the underlying inflation pressures are still below our target. We think that once the supply chain issues come off, we're going to be back in a low inflation environment that we don't favor. And so we're going to keep forging ahead. And so far, we've been betting on his success, and we think that he holds the line. So far, he's done that. Although the yen has taken a beating. I think
they're going to hit.
Yeah, said the quiet part out loud when he said, a weaker yen is better. Ultimately, the cost benefit analysis of a weakening yen is still much better for Japan than the alternative.
Yeah. That's a great point. Let me jump back though. Brendan, we mentioned gas prices, oil prices a little bit. Dropping, I think, over the past few days. They might be up a little this morning. And Biden obviously made some news this week. There's a lot of debate over whether it'll have any kind of meaningful impact, especially for consumers, but calling on Congress to bring about a 3-month tax holiday, gas tax holiday. How are you guys viewing this? What's the latest there?
So just simply on the commodity front, the WTI was trading at $120 a week ago. Now it's down to $106. The AAA average gas price a week ago was $5. So now we're down to $4.93. That's not massive moves, but it is going in the right direction.
Yeah.
The Biden administration knows that the inflation, especially high gas prices, is one of the leading reasons why approval numbers are so low. So it's perfectly logical why they would want to do this gas tax holiday. Won't necessarily have a massive effect on the economy. Could help his numbers, but also learning more and more about how we actually have to do this, because it has to be paid for. It's a lot more complicated from a DC Capitol Hill perspective than maybe people realize.
Yeah. I think
and you're also talking only about what, maybe 30-40 cents gets end up with the to the final consumer. So whether you're paying for what would be that $4.60 a gallon or $4.90 a gallon, I'm not sure that you're going to really get a lot of political tailwind from that.
Yeah. I mean, we've got about, I don't know, I'll probably a little wrong on this, but I think we have something like 12 days left of actual work days in Congress. And just to be clear, Biden's proposing this over strong objections of Pelosi and others. So
yeah.
To say it's a long shot is an understatement. Yeah.
Yeah. I mean, there's no magic bullet here, as we said, but the closest thing you can get to a magic bullet is the trip to Saudi Arabia. And
yes. Yeah.
Just never, it's certainly possible that the Saudis and, UAE and other OPEC members that have spare capacity, but haven't necessarily put it on the line to make up the shortfalls from other members. They haven't really been on side with the Biden administration in a messaging way. There clearly is geostrategic tension. It's wrapped up in the Russia and China versus the West the formulation here that we're seeing, and the Gulf is kind of in the middle, playing maybe both sides against the other, or trying to see who's going to give them the best deal.
Yeah, right.
The Biden administration going to Saudi Arabia, if they come out of that with anything that is, that allows some rhetorical alignment of incentives and goals when it comes to lower oil prices, I think that would be positive. It's hard to think that, if the Saudis came out and said, we're concerned about oil prices getting too high, and we think we can do something about that. That would be a very different messaging and kind of environment. And they may not be able to. They may be not able to make that claim, but it's certainly something that would take the legs out of oil prices.
Yeah, and Biden's
political expert, but Saudi Arabia is spending billions to create a golf tournament to create goodwill and attract foreign investment. I think I might use my political goodwill to lower gas prices in Europe and the United States. I think that would go a lot farther on your return on investment if I'm Saudi Arabia.
Golf tournament has not gone well for them. That's for sure. And I mean, that's a good point. There's obviously a lot of problems with Saudi Arabia, and a lot of big concerns here in the States about, working with them and some of a lot of their past history. But this is where this is supposed to be his strong suit, right? This is where he's supposed to be able to flex those foreign policy muscles he has and deliver. So it's a big test for him as well.
I think that, when you talk with foreign policy experts about U.S.-Saudi relations, obviously the horrifying Khashoggi situation is it's just an enormous blot on the record, and it's something that obviously the Biden administration has had a lot of problems with.
Back to 9/11. Yeah. A lot of, yeah.
But when you hear about some of the other commentary, which is, the things that MBS is doing at home in terms of reform, you hear a lot of positive assessments of that, and basically clipping the wings of the religious police, liberalizing some of the restrictions around what women around women and so forth. And so there's a little bit of a but for this,
right.
For this, we might be in a very different space with relations, and the U.S. might be finding a lot more that they could like about this new regime in Saudi, despite some obvious questions.
Yeah. Well, like we said, big test for Biden with this. Guys, I think that's a lot for this week. Brendan, I know we talked about a few things coming up next week, but anything else we should be keeping our eye on?
The main number is we get the Fed's preferred inflation measurement, the PCE price index, and they focus on the core, which they target at 2% over time. It was at 4.9% in May, so this is the June reading. And we also kind of get a look through because most of the measurements come from the CPI and the PPI. So the projections are that it actually should be significantly lower than what the May CPI printed at. So the Fed might have a little more leg to stand on when discussing PCE rather than CPI in terms of not because of this number, but in the coming 2 or 3 numbers. The PCE inflation year over year numbers could look a lot lower than the CPI. We could be down in low, high 3s, low 4s comes September timeframe.
Yeah, great. Well, guys, let's leave it there. I'm sure there's plenty of other stuff we could tackle, but appreciate you guys letting me sub in once again, and hope to be back on soon. But next week, I think Mr. Fratto will return with hopefully some good intel on what's going on in Europe for us too. So thank you all for listening to the Macrocast. We'll see you all next week.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.